Hey everyone, we are live or going live very shortly. Just give us a couple minutes to get set up and then we will get started. Thank you so much for joining. Fire scandals and everything else of insurance in 2025. I apologize for the technical difficulties. The YouTube is not clicking in for some reason. It says waiting for us to start. So I'm going to try to go into the YouTube and start it manually. Click on. Welcome, everyone. Sorry for the technical difficulties. Welcome to Fires, Scandals, and Controversy, the shocking reality of insurance and our lives in insurance in 2025 in the United States of America. I'm Aaron Gordon, Vice President of Gordon Companies, I. David Gordon Associates, an independent, trusted insurance advisory firm based in New York City, but working all around the country and around the world. Proud to say that we have entered our 56th year, honored to continue the legacy of my late father, David Gordon, whose wisdom you will probably hear today and to whom I dedicate this production. And equally as privileged, if not more, to get to work with my awesome mother every single day and get to continue what she built and a lot of her wisdom you will hear as well. I'd like to divide this session into 3 parts, answering most of the questions that I received over the last few days when we put this out. And obviously, if you're seeing this content later, feel free to reach out for any further detail. Part 1, I'd like to talk about how we got where we are and what exactly is going on in the world of insurance, very briefly, because it's not my area of expertise, about United Healthcare and what happened there, more into the property and casualty world with California wildfires and where we are with that, where I think we're going, and what you can do to help yourself, your risk, your family as an individual, and your business going forward. Most importantly, and this is the most important disclaimer that I will give, and I hope that I give it again, but if not, bear with me. I am an insurance advisor, pride myself on being an insurance expert since I was in the womb 38 years ago, and for the last 20 years in the industry. That being said, I'm not an attorney. I'm not an accountant. I am not a regulator. I don't work for any insurance department. I don't work for any government. I am just giving you my opinions based on what I've seen recently, what we've all read, and trying to pull back the curtain so that you can better understand what's going on in your life as an insurance consumer going forward. The first thing that we need to know about what's going on in the world of insurance is that for the most part, any insurance company that you've ever heard of and any insurance company whose policies you purchase and whose money you hope to give you in the event of a claim is a for-profit entity. These companies, public, some private, need to make profits for their shareholders. The job of the CEO of those companies, the fiduciary responsibility of those leaders is to make profits. We may like it, we may not like it, but that is a fact of the capitalist economy in the United States of America in insurance. And that is the basis of every decision that they must make. So when we hear of the CEO of a health insurer being murdered in cold blood in my city, New York City, my favorite city, for potentially claims that were denied, services that may or may not have been provided, promises by employees that may or may not have been made, we have to understand that ultimately is the job of that CEO to provide their shareholders and stockholders with a profit, just like you and me and any of our businesses. That doesn't mean that the insurance industry wasn't built and shouldn't be built on doing well by doing good. But it does mean that these people, and we all, need to focus on the profits. And this cannot be made more evident than what's going on in California today. I can tell you that I have friends, close friends around the country that represent companies that have been bashed in the media. State Farm, many others, where you're hearing that companies have pulled out of the state of California, left people homeless or without their insurance or with no other option. And I have to tell you, as someone who, as I mentioned, was born into the insurance industry and brought up in this industry, that is the most painful part to me. Yes, it is tragic that people have been left without coverage or underinsurance, which we will get to. But for me personally, to say that individuals are responsible or that entities without warning canceled insurance, which is against the law, and left people without options is the fault of the consumers, of all of us across the United States of America, of all of our elected officials, and of the system that was set up. But this has nothing to do with individuals wanting some people not to have insurance or others to be canceled or favoring some people over others or the rich over the poor. This simply has to do with capitalism and insurance companies that are for-profit entities. So now let's jump into what happened. The first thing we need to know, and I say this somewhat with pride, people over the last couple of weeks have heard me say this, my friends who have reached out to me who are in the financial fields and everywhere else, is very unfortunately, the insurance companies were right. And I say unfortunately for the citizens of the state of California who are impacted by this, but not for those of us who are in the industry. Because we pride ourselves on being trusted advisors. I'm working with companies that have areas of expertise in the coverages that they write. And if we look at the companies that for reasons having to do with sometimes litigation, sometimes legislation, and sometimes just actuarial data, we see that the insurance companies were proved right. What do I mean by this? There are laws in every state of the United States of America which govern the rates that insurance companies can charge for a given risk. If we understand that insurance companies are for-profit entities, then we understand that these very insurance companies must think about how much premium they are taking in versus the risk that they are taking going out and those claims that may be paid. If you've watched any of my content or listened to my podcast or heard me anywhere else in the insurance speaking circuit or on insurance podcast, you know that my father of blessed memory used to say, and it's one of my favorite lines, that as agents, we may get our commission, when we sell the policy, but we earn it when there are claims, which means that ultimately insurance companies may sell a policy, but that policy is sold on a promise to deliver in the event of a loss. We have to deliver certainty in an uncertain world, and our carriers have to do that. And if it is true that our carriers have to do that, then we understand that they have to look at their profits. And so in the state of California, the state that takes the longest in the United States of America to get rate increases or rate changes or coverage changes approved, sometimes more than 365 days, a full year to get a rate change approved. We see that insurance companies do not operate in the free market. And because the insurance companies do not operate in the free market because of laws like Proposition 103 and others, then we understand that the insurance companies need to have foresight or need to try to foreshadow what losses may come upwards of a year in the future and say, what do we need to charge for a given risk? And so if you're a consumer in a state like California, but by the way, this is not unique to California. This can be flood risk in coastal Georgia or New York, or hurricane risk in Florida and other places like that, or even wildfire risk in places other than California. If you're a consumer, you have to understand that that insurance company is evaluating your risk well in advance. And those decisions are being made based on prospective modeling that are done by the insurance companies and their actuaries. And so in the state of California, one would assume that insurance companies made the difficult decision, most insurance companies made the difficult decision to stop writing business, non-renew their loyal customers in those states because they were unable to come up with a model that allowed them to write the business profitably. Now, I'll get back to this statistic in a minute, but just to understand exactly what we're talking about here. In the recent wildfires in the state of California, there are varying estimates, but the estimates of the actual losses in the state vary somewhere between $100 and $150 billion. Yet we know from the insurance company data that the covered portion of those losses is somewhere between 10 and 20 billion. So this means that the insurance companies did not take the risk of losing that $100 to $150 billion because they somehow foresaw what may happen. And the insurance companies that did stay and the people that didn't take on those premiums because they said they were too high. If someone is trying to take on a risk, understanding how to insure a business or a home or anything in between, we have to understand that the insurance company must figure out what they need to charge in order to make that money back. As I said, we're talking about for-profit entities. And the average insurance company has somewhere between a 20 and 30% expense cost with that policy, which means that the insurance company must remain profitable on 70 to 80% of your premium. So if you spend $1 with the insurance company, they automatically spend 20 to 30 cents, which means that you cannot have claims that exceed 70 cents. So if the insurance company believes that there may be a catastrophic event that will come along and cause $100 to $150 billion in damage, that insurance company must charge extremely high premiums. And so what you're seeing in the news and what you're hearing every single day are people who are saying that either their insurance was canceled or non-renewed, or they could not afford that premium going forward. That has to do with the free market economy. That has nothing to do with anything else other than the free market economy. Understanding that the cost of insurance had to be what it was. And those insurance carriers were forced out of the state because the state of California did not allow them to make their rates based on forecasting, reinsurance costs, and the future. And therefore, those insurance companies, which are for-profit entities, which want premium dollars more than you want to spend them, they want to take them, were forced out of the state. So what happened? One can say that these wildfires and the tragedy that has been and the catastrophe of the last few weeks was predicted as long ago as in 1968, when the FAIR Plan in the state of California was created. Like many other states, California as a state realized that they had a big problem, and this was the risk of wildfires. And so the state created an insurance plan similar to flood insurance in some states, similar to wind insurance in other states, wind pools and the like, created an insurance plan which every citizen in the state of California can buy into if they are willing to pay the premium for insurance coverage. Now, where did this fall short? How did we end up with $100 to $150 billion of losses and only $10 to $15 billion in covered losses? And here lies the rub. Even though every consumer in the state was offered the coverage and could have gotten the coverage, and in many cases was required to have adequate coverage by their lender or by some other outside factor, we see that in this case, only 10% of the coverage was purchased. Why? Many people say that it wasn't going to happen to them. There are those that said that the coverage was too limited, which is true. There are those who said that the coverage might have been too expensive, which, as I mentioned earlier with the stock companies, the FAIR plan is also going to be in financial trouble now, because even the 10 to 15 billion, which is covered, most of which by the FAIR plan or some of which by the FAIR plan, that was more than the premiums that went out. And as I said, claims out must be less than the premium that comes in. So we have a state-backed insurance plan, which is not funded by the state, but rather is funded by the insurers that wish to do business in that state. So if you are an insurer, and again, I'm staying out of politics and I'm just a simple insurance guy. If you are an insurer who wants to do business in the state of California, you have to not only submit your rates based on the very, very rigid and strict guidelines of the state, you have to not only wait for the state to get back to you, sometimes for close to a year, but you also have to participate in paying the losses of the FAIR plan. Now, this is not unique to the state of California, but what is unique to the state of California are the massive requirements that are put on those insurance companies. And as you can see, and as we understand from recent events, the fact that the premium is not being purchased and the policies are not being purchased. So that's how we got here. I'd also just like to make one other mention of insurance in general. And that is, when we talk about the difference between covered losses and uncovered losses, one thing that has yet to be seen, which anyone who has spoken to me in the last couple of weeks knows I've spoken about ad nauseum, and that is even the coverage that exists, there is a question as to how much will be paid. Because as we know, and as I've said, and I will continue to say throughout the course of this live stream, insurance companies are for-profit entities. So insurance companies are only going to pay based on the strict guidelines of the legal contract between the insured and the insurer. So for instance, if you have an insurer that says that they will only pay in the event that you rebuild your home or you bring your business back to the location at which there was damage, you can't just a person can't just cash out of their homeowner's policy unless they're with one of the very few insurers that allow for a cash out option, which means that we have miles and miles of destroyed homes and maybe some people who will rebuild. And if they don't rebuild, and if people have moved out or moved on or decided that the risk is too much, they may not even collect on the 10 to 15 billion of estimated covered losses. So that's where we come from. And I'm going to get into my passion, which is risk management and trusted advice in a minute. But I'd like to predict where we're going. And again, disclaimer, I don't work for an insurance company. I don't work for a reinsurance company. I'm not an actuary. I'm not an accountant. I'm not a lawyer. I'm a simple insurance trusted advisor, AKA the NY Risk Advisor. I believe that nationwide, we will all see rate increases and coverage limitations like we could never have imagined before. If inflation taught us anything, it's that the insurance companies understand the increased cost of risk and the increases that they need to place on us, the consumers. And I say us because one thing that you should think about when you're speaking to your trusted insurance advisor is that most of the time they too purchase the exact products that you're discussing with them. So when you see a 20% increase, I see a 20% increase, as do my friends around the country, from Ohio to Alabama, from Florida to California, nationwide and worldwide. I believe that we will see in the reinsurance market, which I will explain in a second, increases anywhere on the property side from 15 to 25% over the next 12 to 18 months. You may think that your insurance company can absorb your losses, but most importantly, your insurance company purchases insurance. And this is called reinsurance. Reinsurance costs are one of the number one drivers of the pass-through cost to an insurance consumer. We spoke about expense costs earlier, anywhere between 20 and 30 cents on the dollar. And then there's reinsurance costs. When your insurance company's cost to cover themselves, to insure themselves, goes up, so too does your cost go up. And I say you, but I mean us. So too does our cost go up. Additionally, the same way that our domestic insurers may tighten their belts, as they say, or may become stricter on their underwriting guidelines, so too may their reinsurers. So you may have a particular insurance company that could previously underwrite your risk that now cannot offer you a policy because if they do, or if they do with the same broad coverage that they did before, their reinsurance will not kick in. And therefore, if you have a loss and they need to tap into their insurance, which is called reinsurance, they won't be covered. And then that will dip into their profits. And then they will lose their jobs because, as we said, this is a capitalist economy. So I think that we are in for not only extreme rate increases, and don't just think that this is going to be on the property side. I think that we will see rate increases on these in the specialty market and on the liability side. Additionally, not only have we seen an increased litigious society and plaintiff-friendly United States, but the insurance companies that insure both property and liability are going to have to increase their rates, on both ends. Which means that even though we'll see greater increases on our property insurance, those of us that purchase liability primary and excess liability insurance, and this could be your auto insurance, we will see similar rate increases. So what can we do to help ourselves in these turbulent times? And no, I don't think that every single person should move out of the state of California. I don't think that if you live in Long Island, New York, well, maybe you should move to the great city of New York, to the 5 boroughs. I'm just kidding. I don't think that you should move out of your home or move away from the school district that you want to be in or move away from the places that you want to be. But I do think that you should think about the risk that you have. If we've learned anything over the last few months in the United States insurance economy, through the fires, the scandals, and the controversies, it is that we must be educated consumers. We no longer have the luxury of just clicking online, doing a comparison and thinking that we should just drive to the bottom line of commoditization of insurance products. Rather, we must lean on the trusted advisors that we know and love. And yes, it is true that I wish that I could be everyone's advisor. I wish that every single person who sees this now and in the future decides that I should be their independent, trusted insurance advisor. But I know that that's not the case, and I know that that's not what's best for you. What's best for you, the consumer, is to make sure that you find an advisor that you trust, someone local, someone who you think understands the market, not just someone who's focused on dollars of a large corporation, but even though they are working for a for-profit entity, cares about you. That is the best thing you can do. You must engage with a trusted advisor, if for no other reason than to understand the risks of the products that you choose to consume or to not consume, to purchase or to not purchase. The limitations that you have taken under, by the way, may be in default of your mortgage and of your loan. I asked my family a question the other day. I was speaking with my wife and my mother-in-law about this recent situation in California. My in-laws used to live in California. My wife grew up there. And I asked the question of what happens for the people that didn't purchase the right insurance. Not only do these people not have a home, but they may be in default of their mortgage. They may have an impact on their credit, all because they decided that they did not want to purchase the insurance or that they couldn't afford it. Now, when a person makes that decision, as I said, becoming an educated consumer, very often and until now, many people did not choose to follow what was required by their lender. And therefore, not only do we have people, as I mentioned, who may have losses that are not covered, who may have covered losses who don't collect on those losses because they are not going to follow the terms of their policy and therefore rebuild. But we have folks whose credit is going to be impacted. And we know that these multi-million-dollar, multi-$100,000 losses and impacts on individuals' credits can last decades and generations for individuals, for families, and for business owners. So the most important thing you could do is engage with a trusted advisor. Know your coverage and make the right and smart decisions. But there's another thing you can do. You can become a risk manager yourself. You can engage with your trusted advisor personally and commercially. And you can understand what you can do to help yourself manage your own risk. Now, when we become active, proactive, and smart risk managers, two things happen. First and foremost, we either avoid or limit the impact of claims that may come our way. Take, for instance, a sprinkler system. Those who have a sprinkler system in their home or in their business, if there is a fire, they don't avoid the damage, but they can limit the damage. But if they have smoke detectors with the sprinkler system, we may be able to catch that fire early and therefore limit its damage. But how does that help us in the event of a wildfire? You may have seen recently that there are insurance companies that have engaged with private fire departments to help their insureds. You may have heard that there was a run on water in the state of California. But there's plenty of things that can be done to protect our homes, our contents, and ourselves in our daily lives. There's fire protection, there's wind protection, there's water protection, there's driving safety. All of these things we can do to help ourselves become less risky. And when we do that, not only do we avoid the claims in the first place, not only do our potential claims become less severe, but they also become less frequent. And when our losses and our claims become less severe and less frequent, not only are we able to sleep better at night, but we're also able to purchase better insurance. Because I believe that one of the most important impacts of recent events in the United States of America will be that those insurance companies that are the preferred insurance companies will become stricter in the risk that they take on. Now, I'll tell you an interesting part of this conversation. I believe that those people that do rebuild in the state of California may have a leg up because of new fire codes and new restrictions and new risk management that they may be able to put in their homes. So the same home that was, let's say, a negative risk before, may be a more positive risk in the future. But every single person and every single business has the opportunity to mitigate their risk, to research simple things and complex things that can make their risk more affordable and more desirable with insurance companies. Now, I, for one, can't hide, as I mentioned, I'm an independent insurance advisor, and rate increases are great for those of us that earn our living on commission. But for those of us that have grown up, that believe passionately in the industry that we're working for, and I speak to my friends every single day, and we feel privileged to have fallen into this industry, not just because they say that insurance agents play a tremendous amount of golf, but because we get to do well by doing good and help those around us. We too want to be able to help our clients. We don't want to just see astronomical rate increases. We don't want to see the market disappearing, and we certainly don't want to see fly-by-night companies that are not financially stable and do not have the experience in the risks that they are underwriting, taking on your risks, because then we won't be able to deliver on the promise of paying your claims. I'll reiterate once again the motto, the foundation of all independent, trusted insurance advisors' life. And that is, while we may get our commission or make our commission when we sell the policy, we earn it when our clients and our consumers have claims. So we want to help you. Reach out to your trusted local insurance advisor. Ask them the question. Ask them how you can become a more desirable risk. Ask them what you can do personally and professionally to not only lower your costs, but to create an environment where you can obtain insurance in the future. So we got here because of a mess. We got here because of proper predictive modeling by insurance companies and maybe improper legislation and litigation. We're going to an even darker place. We're going to a place we just heard a new president. Whether you agree or disagree with the policy, we could say that times are changing. And in the insurance world, we are going to a place that's going to be difficult in the short term. The best thing that we can do, and where we must go, is make sure that we understand the predictive modeling, understanding where we stand in that equation, and understand what we can do to help ourselves, our families, and our businesses protect themselves and continue to be prosperous. And the best way we do that is by engaging with our local, independent, trusted insurance advisor. If there's anything that we've learned over the last few months, it's that insurance cannot be a commodity. Insurance must be a valuable part of our personal and professional boardroom. It must be something that we look at as carefully as we do our taxes and our legal documents. Because in the end of the day, we must ensure that our insurance comes through for us when we need it most. I'll open up the floor to questions now. I thank you for joining me. I thank you for coming along for the ride. I wish you all the success in the turbulent times ahead. If you need to reach me, you can reach me on any social media platform at NY Risk Advisor. If you're looking for a local trusted insurance independent agent, reach out to me. I will gladly connect you with my friends across the United States of America and we will make sure that we can ensure to help you going forward in the future. Thank you very much. Okay, we're going to leave another minute for questions, YouTube, Twitter, or in Riverside. I want to just take a minute to give a few thank yous. I should have opened with this, but I mentioned my parents. But while I have a captive audience, I want to thank first and foremost my wife for putting up with all my craziness. I know that she's watching. I want to thank the rest of my family, my siblings, and my siblings-in-law. I want to thank my awesome producer, Haley, who I know is now going to be very upset at me, but any content that you see of mine, any content that you like, if you love it, if you want to work with Haley, reach out to me and I will gladly connect you with her and her awesome business. And of course, to my close friends, you guys know who you are. I see a couple of you guys in the chat. I know nothing about college football, but I think there's something going on tonight. Are we supposed to be rooting, I think, for Notre Dame? I think that's who I'm going for. I think that's the plan. Bradley, I think you're with me on this. I'm not sure about those people from Ohio. I'm not sure if the stars are going to align. Kat, yes, I'm talking to you. Anyone else who may be there, to my close friends, thank you for being along the ride with me. Thank you for having fun every single day and for fighting the good fight for the people who consume our insurance coverage. Thank you, everyone.